So we got some big news.
President Trump says he's going to announce so-called reciprocal tariffs on every country with duties placed on the U.S.
A new round of executive orders signed by President Trump today, this time for tariffs on goods from Canada, Mexico, and China.
President Trump's tariffs on Canada, Mexico, and China set to go into effect tomorrow, barring a last-second change of heart.
But what does that really mean for you? What's going to happen to the housing market when those tariffs do go into place? What's going to happen to home prices? Are they going to shoot through the roof? Will it create more inflation and drive up interest rates? And more importantly, what should buyers, investors, and home builders be doing right now to prepare? So I've been closely tracking the real estate market, inventory, and home buying trends over the last 10 years. And let me tell you, this situation might have some major consequences on affordability, inventory, and on mortgage rates. So if you're thinking about buying, investing, or building a new home in 2025, you need to understand the impacts of these tariffs. On this channel, I break down real estate trends, market shifts, and investment strategies to help you navigate the housing market and to empower you to make better decisions. So if you want to stay ahead of the game, be sure to like, subscribe, and turn on these notifications. Because trust me, there's certain things going on right now and you don't want to miss them. So let's start with the basics. What are these tariffs? How does it impact you? And why should you actually care? Well, let's quickly run through an itemization of these tariffs. So a 10% tariffs on Chinese goods has already gone into effect. A 25% tariff on all steel and aluminum is coming down the pipeline. Canada and Mexico, which are the two largest suppliers of steel and lumber to the US, will both be affected. So why do tariffs matter to home buyers and investors? Well, if builders have to pay a higher price for materials, they're going to pass that price on to the new homes they build, which means buying a new home is going to be more expensive. Now, these tariffs might also result in fewer homes being built, which is going to tighten housing supply and potentially increase housing prices as a result. And if these tariffs impact inflation, that will directly impact mortgage rates, which makes housing more expensive and drives up affordability. So here's what home buyers and investors need to watch for right now. In the short term, builders may rush to complete their projects faster before these tariffs go into effect, so we might see a little spike in inventory this summer. Now, some builders and developers may pause or delay the new builds until the tariff outcome kind of surfaces, and that may shrink inventory in certain markets. And in the long run, housing prices are likely to rise due to the increase in construction costs for builders and developers. So if builders have to pay more for materials, what does that mean for home prices and affordability? Well, let's take a look at the key home building materials that might be affected. The first is lumber and plywood. 30% of US lumber comes from Canada. These new tariffs could raise the duty rate to 40%, which will add thousands to new home build costs. Next is steel and aluminum. Both of these materials are used for framing, roofing, and structural components. It's estimated that the higher cost of steel and aluminum could add up to $4 billion of construction expenses nationwide. Then you got drywall and gypsum. These are essential materials for walls, plaster, and cement, and are primarily imported from Mexico, Canada, and China. Then there's plumbing, electrical, and HVAC systems. Many of these components also come from Canada, which means heating, cooling, and electrical costs are likely to rise for builders and developers. And don't forget about appliances. You get refrigerators, ovens, and a whole bunch of other appliances are heavily imported from China, which will add costs to those as well. But I think the real problem is going to be housing supply and housing prices. Many builders are already discussing either delaying or totally canceling new projects due to higher costs. Smaller builders might completely go out of business, which will further limit new housing supply. So with fewer homes on the market and tighter inventory, home prices have nowhere to go but up. Now, when it comes to the cost of new homes, the National Association of Home Builders estimates the impact from these tariffs could increase home prices anywhere from $5,000 to $10,000 per home. You also got to factor in builder markups, which could add another $3,000 to $4,000 on top of that $5,000 to $10,000. Now, this is not great news for first-time home buyers. For the last 2-3 years, prices and rates have already impacted affordability, making it challenging for many home buyers to enter the market. This is not going to help. Home buyer demand is growing monthly as more millennials and young families enter the housing market. So if inventory doesn't increase, we're likely to see more bidding wars, which of course is going to drive home prices up even more. And as I film this video live, the Fed has already met once in January and did not cut interest rates. So if they don't cut interest rates later this year, which they likely won't, we're going to see higher home prices and higher rates continually impacting affordability. Now, there may be a silver lining here for home sellers, though. If inventory does remain low, sellers might be able to command a higher list price and make more money. However, if interest rates keep rising, that buyer demand might cool off, and that could also impact sellers. Now, of course, I can't make a general blanket prediction for the entire country because we all know that real estate is local, and every different city, every pocket, every neighborhood has a different dynamic market to market. Now, let's talk about mortgage rates. We all know mortgage rates have been lingering in that 7% range for the last 2 years, but will these tariffs make things worse? So why would tariffs drive up interest rates? If the price of materials rise, driving up the price of home prices, it's likely that will also increase inflation, which has a negative impact on mortgage rates. And if inflation continues to rise, it's more likely that the Federal Reserve keeps interest rates higher for longer. And the 10-year Treasury, which also directly impacts mortgage rates, has started to toggle up a little bit as news of tariffs create turbulence in the market. Now, with mortgage rates already hovering in the 7% range, you got some of these negative Nancy's skeptical, pessimistic predictions saying mortgage rates can now even jump to the 8% range by the end of 2025.
I don't believe that,
but some people think that might happen. And as I'm sure you could imagine, every 1% increase in mortgage rates could be hundreds of dollars a month increase to your mortgage payment. For example, a $400,000 home with a 7% interest rate has a $2,661 principal and interest payment. That same $400,000 home at an 8% interest rate jumps to a $2,935 monthly payment. That's over $3,000 a year in interest alone, just from a 1% jump in interest rate. So what should home buyers do right now to prepare? Well, if you're in the market and you're serious about buying, don't wait. Jump on the next house you see that you love, that checks the boxes, because it's likely home prices and maybe even rates go up in the next couple months. Another idea, if you have the opportunity, is to negotiate a buy down from the seller. Ask them to buy down your interest rate to keep your housing costs lower. You can negotiate that with a great realtor. And the third option is locking in your interest rate before the Fed reacts to the potential inflation, which will be impacted by those tariffs in the next 30 days. Now, beyond home prices and mortgage rates, these tariffs can also directly impact renters and real estate investors. Builders don't just build single-family homes. They also build and develop huge apartment buildings for renters. And if that development slows down and there's less inventory for renters, that increased demand could drive the price of rents up. And landlords are likely to pass on the higher maintenance costs to their tenants. I mean, if landlords have to deal with higher maintenance and repair costs, they're going to pass those on to their renters in the form of higher rents. And these trends are likely to cause more demand for subsidized housing and Section 8 housing, which means there's going to be more demand for that type of property, which means there's going to be less available. When it comes to flippers and people doing the BRRRR investment method, there might be some impact there because of the higher renovation costs that's going to cut into your profit margin. Investors that have long-term investments, so those are properties where you have a 1 or 2 year lease, this might actually help you because you can charge a premium on your rent and make more profit. And when it comes to multifamily properties, 2 to 4 units, people doing the house hacking strategy, you might benefit as well because, again, there might not be as much property available, so there could be more demand on your type of property, and you could charge a premium for rent. So should you invest in real estate right now? You have to tread lightly if financing costs continue to rise, aka mortgage rates. If mortgage rates are high and you're looking to buy investment properties, you really got to pinpoint what your monthly expenses are going to be, what your market rents are, so you can determine, are you going to cash flow? So we covered a lot of information today. Let's break down the key takeaways for home buyers, sellers, and real estate investors. So for home buyers, if you're in the market now in 2025, don't wait too long. Mortgage rates might rise, demand might increase this summer. I would advise you to buy the next home that you see, that you love, if it checks the boxes and you qualify. And if possible, lock in your rate sooner than later and try and negotiate a seller credit. Sellers are willing to negotiate and offer buy downs, which can lower your interest rate for the first 2 years. This is a great strategy. And lastly, pay attention to new construction homes. If you got some big developers and builders in your market that are building subdivisions, most of those properties come with a builder credit towards closing costs and or a rate buy down already baked into the deal, so your mortgage rate and your payment is lower for the first 2 years. Now, for home sellers, if rates continue to rise, buyer demand might drop a little bit, so it might be difficult to sell your home or to sell for the price you want. So be prepared for more negotiations and having to concede a little bit to get your property sold. Now, for investors, rising rents could help you if you're holding long-term rental properties, but increased costs could squeeze margins for flippers. My professional opinion is buying properties that are already in good condition and getting a premium on long-term rent is probably a safe play. If you're looking to buy older properties and flip them, just be careful of the rising expenses based on these potential tariffs because it could cut into your margin on the back end. Don't forget, there are various creative strategies and creative loan options for investors in all markets, so hit me up with any questions. And if you made it this far, I want your honest opinion. What do you think about the tariffs? How do you think it's going to impact the housing market? Do you think it's going to impact rates? Do you think it's going to impact inflation? I check this channel daily. I answer as many questions as I can. And if you need something specific for your exact scenario, just reach out to me. All my contact info is below. And as always, if you want to get the latest updates and stay ahead of market trends, make sure you're subscribed. Hit the like button if you found this helpful, and I'll see you on the next video.